There's a strange financial habit that almost everyone treats as completely normal. It sounds responsible. It feels cautious. Sometimes it even feels intelligent. And yet over time, it quietly destroys more wealth than bad investments ever could. The habit is simple. Waiting. Waiting until your income is higher. Waiting until you feel more financially stable. Waiting until you understand investing better. Waiting until the right time. And on the surface, that logic makes perfect sense. If money feels tight, waiting feels safe. If markets feel confusing, waiting feels wise. If life feels uncertain, waiting feels responsible. But here's the uncomfortable truth most people don't realize until much later. Waiting to invest doesn't just delay progress. It quietly changes the entire trajectory of your financial life. Not because of one bad decision, but because of a slow, invisible force most people underestimate: time. And the strange thing about time and finance is that it behaves very differently than people expect. When you delay investing by a few years, you're not losing a few years of progress. You might be losing decades of financial momentum. And the worst part? It rarely feels like a mistake when you're doing it. It feels like you're being careful, responsible, disciplined. But in reality, there's a hidden price to waiting that most people only discover when it's far too late to reverse. And once you see it, you start realizing something uncomfortable. The biggest financial risk for most people isn't investing badly. It's waiting too long to begin. And this is where the story gets a little more unsettling, because the people who wait the longest are often the people who are smartest with money. Idea 1. The illusion of "I'll start later." Most people don't delay investing because they're reckless. They delay because they believe they're being strategic. You'll hear it in everyday conversations. "I'll start investing once I'm earning more."
Right now, I just need to get stable first.
"I want to learn more before I put money in the market." On the surface, those sound like thoughtful decisions. But underneath them sits a subtle assumption that investing is something you start after life settles down. And here's the tricky part. Life almost never settles down. Your income grows, but your lifestyle grows with it. Your responsibilities expand. Your expenses quietly follow. And the moment you finally feel ready to invest, life often feels even more expensive than before. So the starting line keeps moving. A few months becomes a few years, and those years quietly compound into something far more expensive than most people realize. Not because you lost money, but because you never allowed time to start working for you. And in investing, time is not just helpful, it's the entire engine. Take two people. One starts investing small amounts in their early 20s. The other waits until their early 30s, but invests much more aggressively. Most people assume the second person wins. After all, they're investing more money. But here's the uncomfortable reality of compounding. Often the person who started earlier still ends up far ahead. Because investing isn't just about how much money you contribute. It's about how long your money is allowed to grow. And this is where many people unknowingly make their biggest financial mistake. They treat investing like something you start when you're ready. But the market rewards something very different. It rewards time in the system. And that leads to the next problem. Because waiting doesn't just delay investing. It changes how you think about money entirely. Idea 2. The lifestyle expansion trap. There's another reason people delay investing. It's not always fear. Sometimes it's comfort. You start earning more. Your paycheck improves. Life feels a bit smoother. So naturally, your lifestyle begins to upgrade. Nothing dramatic. Just normal progress. A slightly nicer apartment. Better travel. More convenience. Maybe a newer car. Better restaurants. None of these decisions feel irresponsible. They feel like normal life improvements. And honestly, they are. But something subtle happens when lifestyle upgrades arrive before investing habits. Your income becomes busy supporting your life instead of building your future. And once your lifestyle adjusts to a higher level, going backwards feels incredibly difficult. Even if your income keeps rising, even if you fully intend to start investing later. Because once your life expands to match your income, your financial flexibility shrinks, and suddenly investing doesn't feel easy anymore. It feels like sacrifice, which is why many people keep postponing it. Just one more year, just one more raise, just one more promotion. But time doesn't pause during those decisions. The market keeps moving, compounding keeps working, just not for you. And the uncomfortable reality is this: the longer you delay investing, the more aggressive you eventually need to be just to catch up, which leads to a strange emotional pressure later in life. You begin feeling like you're behind. And when people feel behind financially, they often make worse investment decisions, chasing higher returns, taking unnecessary risks, trying to compress 20 years of compounding into 5. Which almost never ends well. But there's an even deeper psychological reason waiting becomes so common. and it has less to do with money and more to do with identity. Idea 3, the I'm still early story. There's a quiet narrative many people carry in their early adulthood. I'm still young. I have plenty of time. And technically, that's true, but this idea creates a strange illusion. Because when you're 22, starting at 25 feels early. When you're 25, starting at 30 still feels reasonable. When you're 30, starting at 35 doesn't seem catastrophic. Each delay feels small. Each delay feels manageable. But time in finance doesn't behave linearly. It behaves exponentially, which means the years you postpone at the beginning are often the most valuable ones. Those early years are when compounding has the most space to work, when risk tolerance is highest, when small contributions have the longest runway. But most people spend those years waiting for financial clarity, waiting for higher income, waiting for confidence. And by the time they finally start, they've unknowingly removed the most powerful ingredient in wealth building: time. And this is the moment many people eventually look back and realize something uncomfortable. They weren't avoiding risk. They were avoiding uncertainty. But uncertainty is part of investing. It always has been. The market moves up and down. News cycles create noise. Predictions constantly change. And if you wait for complete clarity before investing, you'll likely be waiting forever. But there's one more reason waiting becomes so dangerous. And this one hits a little closer to home for many people. Because it has nothing to do with knowledge, or income, or timing. It has to do with behavior. And once you notice it, it's difficult to unsee. Idea 4, the quiet comfort of inaction. Doing nothing often feels safer than doing something imperfect. Especially with money. Investing requires action, opening accounts, making decisions, choosing investments, accepting uncertainty. Waiting, on the other hand, feels comfortable. It feels cautious. It feels responsible. But in reality, waiting is still a financial decision. It just doesn't feel like one. Because when you delay investing, you're not pausing the game. You're choosing a different strategy, one where inflation slowly erodes purchasing power, where compounding never begins, where years quietly pass without financial momentum building. And the strange part is that people rarely feel the consequences immediately, which makes the behavior easy to repeat, year after year, until one day you notice something unsettling. You've been working longer than expected, saving harder than expected, and wealth still feels further away than you imagined. That moment can be deeply frustrating, not because you made reckless decisions, but because you followed the financial habits that seemed logical at the time. And this is where the story shifts. Because once people recognize the hidden cost of waiting, their entire relationship with investing begins to change. When people think about investing, they often focus on the wrong question. They ask, what's the best investment? Stocks, index funds, real estate, crypto? But the question that matters far more is much simpler. When does investing actually start? Because wealth rarely appears through dramatic financial moves. It builds quietly through long periods of participation, consistent investing, long-time horizons, calm discipline. The market doesn't reward perfection. It rewards presence, being in the system long enough for compounding to work. And once you understand that, the entire strategy changes. Investing stops being something you wait for and starts becoming something you begin early, even if the amounts are small. Because small contributions with long-time horizons are often far more powerful than large contributions that start too late. And this realization removes a lot of pressure. You don't need perfect timing. You don't need market predictions. You don't need financial genius. What you need is simply a system that allows time to start working, even imperfectly, even gradually, even while you're still learning. Because the real advantage in investing isn't intelligence, it's participation. And the people who quietly build the most wealth rarely look like financial geniuses. They simply started earlier, stayed consistent, and allowed time to do the heavy lifting, which is something many people underestimate at the beginning, but deeply appreciate later. And if this topic made you slightly uncomfortable, that's actually a good sign. Because awareness is usually the moment financial behavior begins to shift, the moment you realize money isn't just about income. It's about momentum. And momentum takes time to build, which is exactly why the smartest investors focus less on perfect decisions and more on starting sooner than feels necessary. If this idea about waiting felt a little familiar, there's another financial pattern that explains why so many intelligent, capable people still end up financially stuck, even with good incomes and strong careers. It's a deeper behavioral trap most people never notice until much later. And once you see it, a lot of financial decisions suddenly make more sense. That video should be appearing on your screen right now. It's the natural next step in understanding how wealth actually builds over time. And if you care about your future financial freedom, it's worth watching next.